course, we always take a look here at Nvidia. In this case, Citigroup lowering the price target this morning.
Yeah, good morning, Nicole. And Nvidia with a rare, more downbeat note from the sell side, as we did see Citi lowering its price target overall on Nvidia shares to $200 from $210. Keeping, though, a buy rating, so don't let the headline necessarily completely depict that it's been as negative as perhaps a $10 a share price target reduction. But they did reduce their now overall Nvidia's 2026 GPU sales estimate by about 4% to reflect now Broadcom's commentary about the accelerating AI chips growth in China. Citi did also say they see a now $12 billion GPU sales hit to Nvidia from Broadcom's XPU cycle. However, if you look at Nvidia, as we know, the commentary has become very clear that it is right now very expensive on a forward multiple and could be perceived as a highly overvalued stock, or in a bubble per se. Many have made the case of why it's not, because for a long time its earnings growth and its revenue growth frankly were able to justify its relatively high forward-looking multiple. But that's been the criticism from a lot of these more neutral to say pessimistic analysts on the sell side. But outside of that, if you really zoom out, right now it trades at 29 times. It's actually come down from historical levels, so it's not even at a high PE by any means. And if you look at right now, the overall sell-side community, you see 59 analysts that do have a buy or buy equivalent rating. 6 holds, 1 underperform, an average price target right now of around $211 a share. So that does imply about 26.5% upside. All that to be said, there's definitely still conviction that is neutral to bullish from the analyst community here. Price target right now of $210 a share, which is basically put you in line with the rest of the average. 200 slightly below the average, sure, but it's not like anyone is saying, dump your Nvidia shares, head for the hills. They're just recalculating, I think, based on some developments we've gotten from earnings as well as the macro and geopolitical situation.
Okay. When I saw Dan Ives this morning, he was still very hot on tech as usual. Right, the big picture, and I know we've had some upgrades today as well, and we'll talk about some of these, but the big picture here, Nvidia at 167 still has upside potential to get to 200, right?
Absolutely, and you still see, like players like Dan Ives, for example, who still has one of these street high price targets, I believe, on Nvidia shares. A lot of these various analysts have said, even as we approached their earnings event now about 2 or 3 weeks ago, there's still room for upside. You look at right now, the street high on Nvidia, which I know this is a stark contrast to Nvidia's note today, but it's still $389 roughly a share. So that would tell you there's still a lot of believers in this name, whether that's been reflected right now of their recent pullback. I think there's still a lot of conviction to the upside. And frankly, just, to look at history and the past performance of its price, people like Dan Ives have been a lot more right than those that have taken on a much more bearish stance on Nvidia. For now, years in the making.
Despite new worries about competition, Nvidia's stock rose on Monday, rising around 2% in morning trading. Citing indications that Broadcom might be moving more swiftly in the competition for AI-related processors, Citi reduced its price estimate on the chipmaker from $200 to $200. Citi pointed out that Nvidia's long-term sales may be at risk due to Broadcom's recent remarks regarding its XPU chips' better year-over-year growth. According to reports, Google is one of the businesses implementing Broadcom's technology, demonstrating the demand from both new and existing clients. This change may inadvertently increase pressure on Nvidia, particularly if Google extends its computational offerings to competitors like Oracle, OpenAI, and Meta platforms. According to the bank, this scenario may result in Nvidia losing up to $12 billion in GPU sales by 2026. The longer-term outlook indicates heightened rivalry in the AI hardware sector, even though the short-term stock movement stayed positive. Now investors are anticipating Nvidia's upcoming significant update. On October 28th, CEO Jensen Huang will give the keynote address at the company's GTC event, which might serve as a springboard for new direction and product enhancements. For many years to come, Nvidia ought to maintain its dominance in the data center sector. The company's GPU demand may rise as a result of AI advancements. Additionally, Nvidia has significant prospects in emerging areas like robotics. Just 4 businesses had market capitalizations of $1 trillion or more 5 years ago, One of them wasn't Nvidia. The market capitalization of the GPU manufacturer at the time was just over $300 billion, so it wasn't even close. How times have evolved. After its shares soared more than 13 times, Nvidia is now the largest corporation in the world, with a market valuation of almost $4 trillion. Over the next 5 years, I don't think that kind of return will occur. But by 2030, I think Nvidia will be valued at $10 trillion. This is the reason. 1. Persistent dominance of data centers. Most significantly, I believe Nvidia will maintain its market dominance in data centers. Indeed, Nvidia has a number of rivals. But I don't think any of them will overthrow the business this decade, and I doubt they will in the upcoming decade either. Nvidia benefits from two important things. First, Nvidia has a strong moat because to its CUDA framework, which enables GPUs to be used in parallel processing for non-graphics applications. Developers would incur significant switching costs if they were to switch from their artificial intelligence (AI) models to chips manufactured by other vendors. Second, Nvidia is making significant investments to maintain its market leadership in data centers. The Blackwell GPU architecture from the business is the most potent one to date. Every year, Nvidia intends to release new chips. Given how quickly the company is innovating, I don't think the competitors will be able to keep up. 2. Growing demand for GPUs as AI develops. As AI develops, I also anticipate a rise in demand for Nvidia's GPUs. A number of AI developments that could give Nvidia some welcome tailwinds are already in the early phases of development. Agentic AI, for instance, is still in its early stages. However, this technology has enormous potential in a variety of fields, including technical support, financial planning, cybersecurity, and customer service. It uses artificial intelligence, AI, to carry out activities with little supervision. Another potential development that can increase demand for Nvidia's GPUs is personalized AI that changes according to users. One of the main objectives for GPT-6, according to OpenAI CEO Sam Altman, is to improve memory in order to make ChatGPT more personalized. Up until now, data centers have received the majority of AI attention. However, Edge AI, where AI operates on local devices, could potentially present Nvidia with a significant opportunity. The Jetson Nano for Edge AI is already marketed by the firm. Furthermore, I cannot rule out the prospect of significant advancements in artificial general intelligence, AGI. According to some analysts, AGI could be accessible by 2030. If this is the case, Nvidia will probably benefit greatly from an AGI gold rush. 3. Growing market potential. Nvidia has expanded into new markets in recent years. I believe that by the end of the decade, a number of those efforts will have paid off handsomely. I concur that robots is Nvidia's biggest prospect after artificial intelligence, as stated by CEO Jensen Huang during the company's annual shareholder meeting in June. It makes sense that Nvidia has prioritized the development of robotics. Additionally, I believe that Nvidia may see rapid expansion in the market for driverless vehicles. Major automakers including BYD, GM, Hyundai, Toyota, and Volvo are among the many partners that currently use the company's drive platform. The figures are accurate. Lastly, the facts support my prediction that Nvidia will be valued at $10 trillion by 2030. According to Wall Street, the corporation is expected to make almost $200 billion this year. Nvidia will require revenue of about $392 billion to reach a market valuation of $10 trillion if it continues to maintain its current price-to-sales PS ratio of 25.5. A revenue compound annual growth rate of about 14.4% would be needed to achieve that. Right now, Nvidia's revenue is increasing at a rate that is over 4 times faster. Undoubtedly, I anticipate a slight slowdown in Nvidia's sales growth. Additionally, I won't be shocked if the stock's PS takes several drops. Both, though, are possible and would still enable Nvidia's market value to reach $10 trillion over the following 5 years. Considering all of the growth drivers that were previously covered, I don't believe my projection is overly optimistic. Timothy Arcuri, a UBS analyst, reaffirmed his buy recommendation and $205 price target for the company. The company is not changing its price goal or buy recommendation, and it is only slightly altering its estimates. The company admitted that some investors may not have been satisfied with Nvidia's forecast, but analysis points to a possible upside of $2.5 billion every quarter, while the details surrounding the 15% cost for licensing to export H20 chips back to China are clarified. So, is it time to purchase Nvidia stock? The most recent quarter for Nvidia shown remarkable growth and cash generation. Even without China's assistance, the guidance emphasizes the strength of the demand for AI. There is limited margin for mistake due to the stock's high valuation. For Nvidia, crowd-pleasing growth is nothing new. However, the late August release from the AI and graphics chip manufacturer still managed to attract attention. The data center engine continued to run well, and revenue increased significantly from year to year. Additionally, management gave optimistic forecasts for the current quarter. Indeed, after the report, shares have decreased. But keep in mind that the growth stock has up more than 240% since the start of last year and is still up 28% so far this year. Nvidia needed to provide outstanding results after a run like this, and it succeeded. Nvidia's AI infrastructure momentum persisted. Revenue for the fiscal second quarter was $46.7 billion, up 6% sequentially and 56% year-over-year. Revenue from data centers reached $41.1 billion, a 56% year-over-year and 5% sequential increase. Profitability is still the highest in the class. The gross margin that was not GAAP was 72.7%. Trends were mixed but healthy under the hood. Because investors are so accustomed to Nvidia's great performance that they frequently evaluate the company's growth based on sequential trends rather than year-over-year trends, I put mixed in quotes. There was one location on this front where the trend wasn't consecutively favorable. Indeed, as the new platform ramped up, Blackwell data center revenue increased 17% sequentially. However, a $4 billion drop in H20 sales caused compute revenue to decline 1% sequentially. More on this later. As NVLink fabrics, InfiniBand, and Ethernet AI build-outs progressed, networking increased by 46%. The mix shift is important. It demonstrates that clients are constructing entire AI systems rather than merely purchasing GPUs. Cash generation continues to play a significant role in the narrative. The quarter's free cash flow was $13.5 billion, and the first half of fiscal 2026 saw $39.6 billion. Marketable securities, cash, and cash equivalents totaled $56.8 billion at the end of the second quarter. With this ability, Nvidia authorized an extra $60 billion for buybacks and returned $10.0 billion in Q2 through dividends and repurchases, mostly repurchases. For any large cap, those are elite statistics that provide management with flexibility in terms of capital return and investment. The short-term tone is determined by risks and guidance. The growth story is supported by the short-term prognosis. Revenue for Q3 FY26 was estimated by management to be at $54 billion, give or take 2%. Along with continuing to estimate exit year margins in the mid-70% range, it also anticipates a non-GAAP gross margin of about 73.5%. Remarkably, this advice is predicated on no H20 exports to China. The final detail is crucial. H20 sales to China were non-existent in Q2, and they are once more not included in management's Q3 estimate. This establishes a clean base case, growth devoid of a boost from China. If export restrictions ease or product roadmaps adapt, upside could emerge. If not, the company still anticipates expanding through networking connected to bigger AI clusters, the Blackwell ramp-up, and the worldwide demand for accelerated computing. However, when we begin discussing valuation, the mood becomes a bit less optimistic. With a foundation of remarkable profit margins and a substantial sales base, the stock's current price-to-earnings ratio of 49 bakes in years of outstanding performance and sustained growth. The fact that Nvidia's market value, which is currently over $4.2 trillion, only yields a free cash flow yield of around 2%, serves as further evidence of the company's excessively high valuation. Living up to this valuation is undoubtedly a possibility given AI's potential. However, there is less leeway in the value for supply delays, rivals' competitive reactions, any steps taken by its clients to reduce the risk of their reliance on Nvidia, or a halt in AI expenditures. Rapid top-line growth, excellent margins, enormous free cash flow, and solid forecast were all hallmarks of Nvidia's successful quarter. Additionally, pullbacks are supported by the balance sheet and buyback power. However, it may be argued that the risks necessitate a lower price before investors should think about making the purchase. Significant risks include possible lumpiness as product cycles and client mix change, continuous China limitations, and a valuation that requires sustained outperformance. This report is fantastic news if you currently own the stock and have a long-term thesis. It can assist you justify holding onto your holdings. However, I would scale in rather than rush for additional money, nibbling on volatility and letting the direction and fundamentals speak for themselves over time. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
With you. All right, let's talk about this chart for Nvidia. It's been a strong performer overall year to date after it got over that turbulent period. I know you've got a 90-day and a 1-year look at this. Let's start out with that 90-day perspective.
Yeah, of course, Diane. I mean, there's a lot to talk about these couple charts here. So, I mean, Nvidia had an incredible run the last few months. I mean, just notching for the first half of this 90-day period, they notched like an 80% gain in just a 3-month period. So for me, I look at this chart and I just think, yeah, it makes sense that it needs to go sideways for a little bit. And that's kind of what we've seen over the second half of this 90-day period is just like a strong sideways moving trend with this range between, I would say, those all-time highs of around 185 and then looking at support down by like 163, 164, which is kind of right above where it's trading right now. And so if that short-term support breaks, obviously traders will be looking for that next level down, which we'll kind of see in that longer-term chart. But it's kind of funny because even looking at the strength of the trend, we saw the ADX over that period. It notched some levels around 50 or so, just showing how extreme that trend is. And now, just because of the force of that recent down move over the last 2 weeks or so, it's again, the ADX is near those strong levels of extreme trend, like right under 40. So we'll just have to kind of see if the support level holds in the short term.
Okay. All right. That's a short-term look. Now let's zoom out and take a look at the 1-year chart and talk to us about the trends you notice.
Of course. So over the longer term, we can see obviously a few more levels that occurred in Nvidia. So we can see that topping pattern that's taking place. And I say that it's a topping pattern because it's that sideways pattern. I've seen a lot of these, and sometimes they just, like I said before, I mean, sometimes the stock just needs to take a little breather before continuing its move. It had a really strong up move before then, which we can see when it kind of whipsawed around its 50-day moving average and then charged higher there. But we have seen a little bit of break in trend here with this latest touch of support. So we did see its first close on Friday, the close below the 50-day simple moving average. We did kind of see a breakdown a little bit in relative strength because it's been that relative strength leader versus the information technology sector too. And that's been kind of a trend line that's been broken too. So like we're seeing little fragments of a possible change in trend, but it's right at support, horizontal support right now, 163, 164. If that breaks, traders will probably look to that next level of support, which we kind of saw take place, which was previous resistance earlier this year, right around like 150, 151 or so. So that's kind of where traders will be targeting. But a lot of times it just kind of needs a little bit of a consolidation, a little bit of a breather before continuing its trend further.